Hi, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley update. And this week we're going to talk about where we are in the market at almost the end of the first quarter of the year, and whether you're a buyer or a seller, or you kind of just want to know. This is going to give you some interesting information because we're really in a fluid market right now. But let me start by telling you about, the slide, the home price growth has remained relatively flat. And you look at it across the board from January 24 for the last year, obviously you see it dipped down in July, but it's been pretty steady and pretty slow at 0.4% right now. So, and home prices are growing at a more normal pace because if you remember, you go all the way back to, August of 2020, after COVID, or at the beginning really of COVID, when we got back in the market, and look at how prices went up, then look at how prices went down, and now look at what they're doing, and you go back to 2019 before COVID, and you can see that actually we're back in a pretty normal market as far as the home prices, staying steady or growing at a more normal pace. Now, the home price forecasts are really interesting because across the board, the average is just under 3%. And, so you can kind of expect the West does a little bit better. You can probably expect somewhere between 3 and 4, 3, 5%. And part of that is because of interest rates. And why are interest rates staying higher? Well, look at this. So the Federal Reserve target rate is 2%. Remember, they're trying to get it down to 2%. And they were doing a good job. You see from 2023, 2022, it was going down and down and down and down. And they started working with the interest rates a little bit, lowering the interest rates. But then all of a sudden, inflation got really stubborn and it's staying high. People talk about the tariffs and prices going up and such forth like that. And so the Federal Reserve, I can remember 6 months ago, they were talking about maybe 5 to 6 clicks down. Then it went to 2 to 3, and then it went to 2. And now the Federal Reserve just came out last month and say we might see 1 click down. And again, remember, the Federal Reserve rate doesn't go directly to mortgage rates. It doesn't, compare directly with mortgage rates. But the mortgage rates do follow the Federal Reserve. And the Federal Reserve money is what the banks get loaned their money at, what your car loans, what your lines of credit is at. But you can see, so it's pretty stubborn. It went down a little bit, but now it went up a little bit. And we're at 2.8%. Remember, until the Federal Reserve gets it down closer to 2%, they're going to be really stubborn on lowering the interest rate, which again, from a ripple effect, will lower the mortgage rate. And the other thing is they don't really see the inflation really coming down because, again, as I talked about, just the economy, potential tariffs, raising prices. So over 50 years, you can see the 30-year mortgage rate has moved in unison with the 10-year Treasury yield. So if you want to know what mortgage rates are going to do, keep an eye on the 10-year Treasury yield because you can see, my God, they're almost a mirror image of each other with an average spread of 1.75. You can see mortgage rate projections. If you remember not too long ago, we talked about getting down into the 5s, and there was actually a lender or two that thought they were maybe going to get down into the 5s. Now look at this. All the way through quarter 1 through quarter 4, they're all like 6.5 to basically 7%, kind of where we're at right now. So no one's really expecting, we're at Fannie Mae or the Mortgage Bankers Association, Wells Fargo, or the average of all three. No one's really expecting rates to come down a whole lot. So if you're a buyer, quit waiting, because again, we still have a lack of inventory out there, but you'll see inventory is rising, but so are sales. So what we're seeing a lot of now is alternative financing. You can have mortgage buy downs, adjustable rate mortgage, or assumable mortgages. Now with assumable mortgages, unless it's a VA or FHA, which there's just not a lot of them in our area, it's not going to be assumable. But definitely the adjustable rates, that's where I would go right now. You can get some adjustable rates. Someone was telling me that they actually were in the high 5s. And sometimes it's a 5-year fix. And I would bank on that probably in the next 5 years they're going to go down and we're going to be able to, refinance. You remember, marry the house, date the rate, then drop the rate when rates go down. So and one of the things that you're seeing with the market is the builders have gotten busier. You can see all the way up, they had 4 consecutive record years. before the big crash of 2008. We literally had 2 million new homes just sitting there. And it contributed to the recession, which was driven by real estate in 2008 through 2012. And then we had 15 years of lower than average building. You go see all the way up to 1970, but now as you see it's growing, that the builders are actually getting busier, so they're adding more inventory, but still trying to keep up with the demand is very difficult. But one of the things I wanted to drop back into interest rates and the mortgage buy downs is the one thing, we have a lot of new building going up in our area. Do you know that just in the Bishop Ranch area of San Ramon, between townhouses, apartments, senior living, and single family, there's 4,500 units being built. That 4,500 households are going to be moving into that old Chevron. You know, you see where they're building in the town center, all around there. So again, we definitely see the builders starting to pick up a little bit. And there's a couple other areas of Danville off of Camino Ramon and Fostoria where that whole development is being developed there. And so, but the incentive most commonly offered by builders right now is the buy down. Rate locks, buy downs, below market rates origination. So they're buying the rate down to a lot of times below 6, because they find at 6%, if they go below 6, that's where they're getting a lot of buyers off the fence. Because remember, most buyers out there have like a 3 to 4% mortgage rates. Matter of fact, 72% of the people have 4% or less. And to really get those people off the fence, you have to really get mortgage rates below 6. Otherwise, it doesn't make sense to them. Now, our market, we talk about being a very fluid market. Look at San Ramon. San Ramon, literally, you see inventory going up and up and up. But look at the pendings going up and up and up. So again, that is a very active market. It's just like we talk about, you know, the tale of two markets. You know, people aren't buying at 7%. They're not buying the home that needs a lot of work, that's overpriced, like when interest rates were 3, where everything was selling. But if a home is priced well and it shows well, the buyers are going after it. As you can see, not only inventory is going up, which it has been going up since the beginning of the year, but now we're starting to see the buyers out in the market, and the pending sales are actually going up also. Same thing, exact same thing in the Danville market. Look at inventories going up, but so are pendings. The Alamo market, same thing. Inventory going up, but so are pendings. Now, Dublin, you know, bucks that trend a little bit. The inventory is going up. Then last week it went down, but we'll see next week what goes on with that. But so overall, it's a very active market. More listings, more pendings, and it's not a buyer's market. It's not a seller's market. It's basically a fairly normal market, just like I was used to years and years ago. Is the fact that, you know, if a home's priced well and shows well, it's going to sell. If it's not going to sell, or it's going to have to be doing some price reductions. Sold price to list price percentages, we've been sticking around 100%, you know, for the most part, and we're still around there, but we haven't seen it go down like we did before. It's actually gone up quite a bit because, remember, there was a lot of price reductions. We're still seeing some, but not near as much as we were before. But again, you know, the market right now is very fluid. So when you're a buyer or seller, it's important to be working with an expert. So put my 47 years of experience to work for you and sit down. And again, when we sit down, there's no obligation. We're trying to build a plan for you together, whether it makes sense to buy, whether it makes sense to sell. Every neighborhood is a little bit different, and we can definitely guide you through that. So give me a call, Joe Kehrig, 925-487-6838, or drop me a text or email, joe@kehrigteam.com. Or if you want to learn more about the Kehrig team, visit our website, www.kehrigteam.com. Have a great week, and make sure you tune in next week, because this market is very fluid, and you're going to want to know.